take other people's money, lend it to different people at a higher rate, keep the difference. Repeat, forever. And if it goes catastrophically wrong, the government steps in. That is a bank. A bank has more revenue visibility than almost any other business on earth. The money is already there, sitting in accounts. The interest is already accruing before the year begins. What it cannot predict is credit losses. How many borrowers will fail to repay? In a severe economic downturn, that number can turn a profitable institution into a troubled one fast. But in a normal year, the engine runs with a reliability most industries would trade everything to have. The spread between what the bank pays you for your deposit and what it charges someone else to borrow it is not a business strategy. It is physics. As long as interest rates exist and people need loans, the gap between those two numbers produces money as reliably as gravity pulls things down. Most businesses have to make something to sell it. A bank makes money by having permission to exist. That permission is called a banking license. And getting one is among the most difficult things a human being can attempt in the financial world. Years of regulatory process, investigations into every senior executive going back decades, capital that must be raised and demonstrated before a single customer walks through the door, business plans reviewed by multiple government agencies that will say no several times before they say yes.
There are more Michelin 3-star restaurants in the world than new banking charters issued in an average decade in the United States. The license is not paperwork. It is a government-issued key to the only building in the economy where the raw material and the finished product are the same thing. Money in, money out. The gap in between belongs to whoever holds the license. Now, here is the thing about your money that nobody sits you down and explains. When you deposit money in a bank, it disappears. Not in a dramatic way, not overnight, but the day after you deposited it, your bank deployed most of it into loans, into bonds, into earning assets of various kinds. Banks are required by regulators to hold a portion as capital against potential losses. But the majority is not sitting idle. It is working. Your account balance is not a pile of your money sitting in a vault with your name on it. It is a number on a screen, a commitment, a promise the bank has made to give it back when you ask. The reason the whole thing works is that most people do not ask for all of it at the same time. The bank is running a statistical bet on human behavior, on the near certainty that on any given Tuesday, the vast majority of depositors will not show up demanding everything simultaneously. It is a bet that has been winning for centuries, with occasional catastrophic exceptions that we will get to. But here is the part that crosses from interesting into genuinely mind-bending.
When the bank makes a loan, your mortgage, the business credit on the corner, the car loan in the parking lot, it does not find the money somewhere and hand it over. It types a number. It opens a ledger entry and creates the money at the moment the loan is approved. Your mortgage did not come from someone else's savings account. It came from a keystroke and a commitment backed by regulation. Banks are not middlemen sitting between savers and borrowers, passing money from one side to the other. They are closer to money creation machines with a credit department attached. Every loan slightly expands the total amount of money in the economy. Every repayment slightly contracts it. The money supply in the entire economy is, to a significant degree, a function of how aggressively banks are willing to lend. Think about that for a moment. The institution holding your paycheck has the legal ability to create money. Not unlimited money, the regulatory framework constrains the leverage precisely, but meaningfully more than what actually exists as physical currency. The bank is not a safe, it is a printing press with rules. Now the spread. You deposit $1,000. The bank offers you 0.5%, $5 per year, barely enough to buy a coffee. That same $1,000 gets lent to someone at 7%. To someone else at 12% on a personal loan, to someone carrying a credit card balance at 24%.
The $1,000 is working for the bank at rates between 14 and 48 times what the bank is paying you for it. You are the silent investor in every single loan your bank makes. You are providing the capital. You are absorbing the institutional risk of holding money at a leveraged entity. Your cut of that arrangement is 0.5%. The only reason you accept 0.5% is that the government decided to make it rational for you to do so. Your deposits are insured. If the bank fails, genuinely fails, cannot return your money, the government covers your loss up to a certain limit. That guarantee is worth far more than the difference between 0.5% and what the market would demand without it. The bank receives this guarantee. The bank does not pay full market value for it. The difference flows into bank profitability, compounding silently year after year for as long as the bank exists. Now, the leverage. Because this is where the mathematics of banking become genuinely extraordinary. For every dollar a bank's shareholders own, the bank controls approximately $10 of assets. This is not recklessness. It is the regulated structure of the business. And here is what it does to returns. Imagine you have $1. You borrow 9 more at cheap rates from people delighted to lend to you because the government is standing behind you. Now you have $10 working. You earned 3.5% on $10.
Your actual return on the $1 you started with is not 3.5%. It is 35% before expenses. Leverage is the telescope that turns a modest spread into an extraordinary return on equity. This is why the largest banks in the world produce returns on equity that most industries cannot approach. It is not because banking is more difficult than other businesses. It is because banking is the only business where the government says you may operate this leveraged with this specific safety net on these terms, and then the bank runs those terms for 100 years. Now, the part that most people who talk about banks completely miss: the spread is only 60% of what a bank earns. The other 40% comes from mechanisms so quietly embedded in everyday life that most people fund them without ever noticing. And some of these mechanisms are, frankly, more impressive than the spread itself. Start with fees. Not the large fees people notice, the small ones that add up like water finding cracks in a wall. Every time an account goes negative, the bank charges a fee. Standard overdraft fees can reach $35 per incident. A $5 purchase that briefly overdrafts an account costs $35 in fee revenue. Expressed as an annualized interest rate on a one-day loan of $5, that is a return percentage so high it would be illegal in most loan agreements. But it is not a loan agreement. It is a service fee.
And the distinction is everything. Wire transfer fees, foreign exchange margins, the 2 to 3% built invisibly into every international payment that never gets labeled as a charge but moves silently from your account to the bank's revenue line every time currencies are converted. Account maintenance fees, return check fees, stop payment fees, late payment fees. None of these individually seem significant. Across hundreds of millions of accounts and billions of transactions, they accumulate into a revenue stream that makes most standalone businesses look modest. Now the credit card. This is possibly the most elegant revenue mechanism in the history of commerce. You use your credit card at a restaurant. The restaurant pays for it, not you, the restaurant. Every time a card is swiped at any merchant anywhere in the world, the merchant's bank pays a fee to the card issuing bank. For standard credit cards, this interchange fee averages around 2% of the transaction value. For premium rewards cards, it is higher. This means your bank earns money every time you spend money, regardless of whether you pay your balance or carry it. The reward points your card offers, the miles, the cash back, the hotel nights, are funded almost entirely by that 2% coming from the merchants you buy from. Your bank designed a system where small businesses effectively subsidize your travel rewards program, and you never see the mechanism because you never pay the interchange fee directly. That is the front of the credit card machine. Now the back. Roughly half of all credit card holders carry a balance from month to month rather than paying in full. On those balances, the bank charges interest. Not at the modest rates charged on mortgages or car loans, at rates that typically range between 20 and 29% annually. The same bank paying depositors 0.5% on savings is charging credit card revolvers 24% on the other side of its balance sheet. The spread on that specific product is not 3%, it is 23.5% in a single product.
Card services at the largest banks is not a small division. It generates more quarterly revenue than most Fortune 500 companies produce in a year. Now, trading. This is where the bank stops being a lender and becomes something with a different kind of advantage entirely. Every major bank runs a trading operation. It buys and sells bonds, currencies, derivatives, and equities on behalf of clients and, within regulatory limits, on its own positioning. What makes this operation different from a hedge fund or any other market participant is the information environment it operates in. The bank sees aggregate order flow from thousands of institutional clients simultaneously. Strict internal regulations, the so-called Chinese walls, legally separate the client advisory side from the trading desk, preventing direct use of specific client intentions. But the positional advantage is structural. Being at the intersection of more capital movement than any external participant can observe creates a market intelligence that no outside player can replicate. Not from access to secrets, from proximity to volume. It sits at the intersection of more capital movement than any external participant can observe. A trading floor at a major bank is not competing on a level playing field. It is operating from a position that would require decades of relationship building to approximate from outside. And it charges for every transaction routed through it, every risk it intermediates, every market it makes. Trading revenue at the largest banks runs into the billions every quarter, not as a bonus business on the side, as a structural advantage built from decades of being where the money flows. Now, the one that produces the highest return of anything the bank does: wealth management. When a bank manages money for wealthy clients, running portfolios, advising on investments, handling estate planning, managing family offices, it typically charges around 1% of assets under management per year. 1%. Passively, regardless of market conditions, regardless of whether the year was good or bad. 1% of whatever number is sitting in the account, collected quarterly. The beauty of this business is that it is almost entirely capital light. The bank does not need to lend anything. It does not need to take credit risk. It does not need to borrow from depositors to fund it. It needs relationships, reputation, and the infrastructure to run portfolios. In return, it earns 1% per year on whatever the client deposits. And if the portfolio grows, which over time most portfolios do, the 1% is applied to a larger number the following year. This is not a business. It is a perpetual motion machine. The assets compound. The fee base grows automatically. The bank charges 1% of a number that tends to get larger over time without the bank doing anything differently. The return on equity in wealth management divisions consistently runs at 40% or higher at the largest institutions. Higher than lending. Higher than trading. Higher than investment banking. 40% return by managing money that was already there. Then there is investment banking, the fee business of being in the room where decisions are made. When a company wants to acquire another company, it hires a bank to run the process, structure the deal, value the target, negotiate the terms, secure the financing, execute the transaction. The advisory fee is typically between 0.5% and 2% of the total deal value. On a multi-billion-dollar acquisition, that fee is measured in hundreds of millions of dollars for months of work by a team of bankers. When a company wants to raise capital by listing on a stock exchange, it pays an investment bank to manage the offering. The underwriting fee typically runs 5 to 7% of the total raised. When a government or corporation needs to issue bonds, it pays a bank to structure and place the debt. Every major financial transaction in the world economy has a bank in the middle of it, collecting a fee for being the trusted intermediary. The deal business is lumpy. Great when markets are active, slow when they freeze. But when conditions are right, a single transaction can generate more revenue than an entire year of lending from a mid-size regional bank. And finally, the one that is almost invisible even to sophisticated observers, the payment infrastructure. Every time money moves through the global economy, it travels through pipes, clearing systems, settlement networks, payment rails built and maintained by banks over decades. These pipes connect every bank account to every other bank account, process every card transaction,
settle every wire transfer, reconcile every cross-border payment. The banks that own and operate this infrastructure charge for every transaction that flows through it, not visibly, not in a way that shows up on any individual statement,
but in aggregate, across billions of daily transactions across the global economy. The payment infrastructure generates revenue at a scale that rivals the lending business. When you pay your electricity bill, move your paycheck, send money abroad, or tap your phone at a checkout, the infrastructure processing that movement costs money. The banks built it. The banks own it. The banks charge for it. You never see the charge. It is in the price of everything. Now take all of it together. The spread between deposits and loans, the overdraft fees and account charges, the interchange on every card swipe, the interest on every carried balance, the trading advantage of being where capital flows, the investment banking fees from being in every major transaction, the wealth management engine running on 1% of assets that compound indefinitely, the payment infrastructure toll on every transaction in the economy, 7 revenue streams running simultaneously on the same customer base, reinforcing each other. Every product sold deepens the relationship, raises the switching cost, and opens the door to the next product. The customer who opens a checking account might get a mortgage. The mortgage customer gets offered a credit card. The credit card customer gets introduced to investment products. The successful investor gets private banking. The private banking client's company eventually needs an investment banker. 1 relationship, 5 revenue streams across decades.
This is the ecosystem trap. Once you're inside it, the bank is not just your bank. It is your financial operating system. Switching means moving your direct deposit, changing your bill payments, porting your credit history, finding a new wealth advisor, explaining your financial life to new people who do not know you. Most people never switch, because most people never fully map what they have built inside the bank, which is, of course, by design. The most elegant business model ever invented does not just earn money from every transaction, it earns money from inertia, from the accumulated weight of a relationship that has become too complicated to unwind. The bank takes other people's money, lends it out, charges for every card swipe, trades on every market flow, manages the wealth of the richest customers, advises the largest companies, runs the pipes that move every dollar in the economy, and then collects 1% of however large the pile has grown. Repeat, forever.